Good evening, everyone. Welcome back. The second session of CA Inter Financial Management. I can see many excited students sitting already, wishing me good evening. Very good evening, everyone. So we have Anmol, Sushil, Ajay, Nishit, Neelam, Kadambari, Rachesh, Nikita, Manohar, Ramneet, Sankaran, okay, Mohammed, Ashok. Lot of guys. I may not name all of them, but I wish a very good evening, everyone, and I welcome back you guys to the online session of CA Inter Financial Management. Uh, in the last class, we have discussed about the sources of finance and the various scope and objectives and introduction to the financial management as a subject. Now, in this session, we are going to take up a very interesting topic, which is ratio analysis. As you see on the screen, the name of the topic is ratio analysis. Uh, we'll be doing it like in today's session and one more session on Saturday. In today's session, we'll be discussing more about the formulae and their logical understanding. I promise you, you need not remember any of these formulae that we are going to look at. You need not by heart any of them because we are going to understand each one of them in a very logical way. Okay, so let's get started with the topic of ratio analysis. First of all, a question to you guys. What factors are you really going to consider for investment in any company? Looking from your answers, what factors? How will you, suppose you look at the balance sheet and P&L. So what all factors are we going to look when we are looking for investment in any company? Yeah. Tell me guys, which factors are going to be considered by you when you're going to invest in any company? Yep. What all things are we going to consider? Net profit, past profit trends, profitability, profit, share value, creditors, okay, past dividend, profit margin, debt and equity, ratio, liabilities of the company, okay. Okay. So you can get some of the answers which are correct, which are not so correct. Some are clear, some are vague. Anyways, let me just articulate it for you. Uh, from the answers that I have received, I can say people are talking about profits. Okay. Second thing, people are talking about the return. Okay. Then some people are talking about relation between the debt and equity. Okay. Some are talking about the earnings per share of a company. Okay. Some are even saying about liquidity. Fine. Inputs that I got from you. Now, if you look at what factors should we really be looking at, it cannot be just profit, 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 right? Because in the last class we have seen it's not the profit which matters. It's what matters is the cash flow, and moreover, what matters is the value or the wealth creation capability of the company. So to measure all these aspects, we are actually going to look at certain aspects which are essentially targeting. We want to know, first and foremost, we want to know what is the profitability of the company. We want to know what is the profitability of the company. Now, profitability can be from various perspectives. We'll see what all those perspectives are. Second thing that we would be interested in, we would really like to know what is the liquidity of the company. How liquid or how capable is the company to honor its short-term and long-term obligations. Liquidity, we can say both short-term point of view and long-term point of view. Third thing which you can say is how efficient the entity is, efficient, or you can say the level of activities that we are talking of. Fourth point that we can look at is rate of return on investment. Right. So these are some of the parameters or the factors that we need to look at before we make a decision as to which company should be our target investment decision. Okay. So now my question is, how are we going to measure these factors? How are we going to measure these factors? Whether the company is profitable, whether the company is having sufficient liquidity or not. How are we going to measure these factors? A simple way or an answer to this word how is by computing ratios or in some cases percentages. Okay, so we are going to measure these factors by computing certain ratios and percentages. Now, what type of ratios are we really looking at in this case? So essentially, the types of ratios that we are going to cover at CA interlevel is certain ratios are going to be targeted towards liquidity. Certain ratios are going to be targeted towards liquidity, which we can also say that these are a measure of short-term solvency. Second is leverage, which is again a case of long-term solvency. Short-term solvency means how the company is liquid in near term, in short term, that is in current asset terms, whether the company is capable of honoring its short-term obligations. Long-term solvency talks of whether the company is capable of paying the long-term loans and liabilities that it might be having in its balance sheet. The next set of ratios that we will be looking at is the activity ratios, which will talk of the efficiencies in the ratios, or which will be telling us how efficient our company is. And the last set of ratios that we are going to offer is, that we are going to refer is basically profitability ratios, which we'll be talking about return on investment ratios. So we're going to learn a lot of ratios, and these ratios are essentially going to be, a part of our financial analysis. Okay, so these are some of the ratios that we are going to cover. Now let's get started with one by one for each of the ratios so that we are really good enough to understand what these numbers are real. So let's take an example over here. Let's take an example. We have got three companies, X Limited, Y Limited, and Z Limited. So we have got three companies. Let's say X Limited has got a current asset of 10 lakh. Y Limited has got a current asset of 1 crore. If I ask you, which company is better in terms of liquidity? Which company is better in terms of liquidity? Can you tell me company X or company Y? Which one is better in terms of liquidity? In terms of liquidity, which company is really better? Why? Why is more liquid? Well, the answer should be, guys, you cannot actually determine just on the basis of current assets. Just on the basis of current assets, you cannot state, you cannot tell, which company is more, more liquid or which company is safe. Rather, we should be looking at what is the level of current liability also. If you look at current liability level, Let us say X has got a current liability of 5 lakh. Y has got a current liability level of 95 lakh. And if you look at the net current asset position, it is 5 lakh, and Y limited net current asset position is also 5 lakh. Net current assets in both the cases 5 lakh. Can you say both company X and Y are having the same level of solvency because the net current asset is same for both of them? No. Okay, so let me just take another case. Z Limited is having a current asset of 10 crore and it has got a current liability of 9 crore 95. There also net current asset is 5 lakh. Does that mean that all three companies are having the same level of solvency? No, because it's not the net current asset which matters. What matters is basically the ratio between current asset and current liability. So we are actually looking at this ratio called as current ratio. Now the current ratio formula that we have for current ratio is current assets on current liabilities. Current assets upon current liability. So it's a ratio which tells us a relation between asset and the liability both together. Now, if we just compute the current ratio over here, we just compute the current ratio for X, Y, and Z. Let's have a look what's the number are. So for current ratio, what we see over here is uh, here it is current asset upon current liability. So 10 lakh upon 5 lakh, we get a ratio of 2:1. If you look at this 2:1, what is the interpretation that we can say? Interpretation is for every rupee one of current liability, for every 1 rupee of current liability, company has rupees 2 of current asset. For every 1 rupee of current liability, company has got 2 rupees of current asset. It means your assets, current assets are basically double of your current liability. Correct? So if you look at the second case, Y limited, here the current ratio is 1 crore divided by 95 lakh, which is 1.05 is to 1. And the last one is 10 crore divided by 9 crore 95 lakh. That works out to be 1.005. Now tell me which of these three companies are actually more liquid or solvent. We can definitely say, sir, company X is having a better level of solvency as compared to Y and Z, because for company X, it has 2 rupees of current assets for every 1 rupee of current liability. Y limited and Z limited case, it is like for 1 rupee of current liability, you have 1.05 rupee of current assets. And for Z limited, for every 1 rupee of current liability, you have 1.005 of current assets. So of course, X limited is the one where X limited is the one where you find that the ratio is somewhat better, right? So we can generally say that in case of current ratio, uh, if your current ratio is basically higher, so high current ratio implies high liquidity. So high current ratio basically implies high liquidity. Obviously, we are talking of short-term solvents. Okay, so that is one observation that we are making as of now. So if we say, sir, current ratio of 2 is to 1 or 3 is to 1 or 10 is to 1, uh, do we mean that if your current ratio is 10 is to 1, it means it's a very good situation, it's a very favorable situation for the company? It is liquid, it is having a good amount of solvency or liquidity, but there's a problem over here. What's the problem, sir? See, here, very high current ratio. Okay, if the current ratio is very high, it means the company has got very high current asset. If the company has got a very high current asset, it can be due to three reasons. One, it can be due to high stock, it can be due to high amount of debtors, or it can be due to high amount of cash. Now tell me, if a company is having a very high level of stock, it has got a good amount of stock in its godown, what does it imply? What does it imply? Does it imply that the company is doing really good? Doesn't seem to be that, sir, right? Because if the company is having very high level of stock, it means it is not able to sell the stocks in the market. So high stock actually indicates selling inefficiency. Similarly, tell me, what does high debtors indicate? High debtors means you have a lot of money which is due from the debtors, which means you have to collect a good amount of money from the debtors. What does that indicate? Does it indicate high amount of can I say collection inefficiency? Means you are basically inefficient to collect the money from the debtors on time. So high debtors indicate collection inefficiency, right? Okay. If you have very high level of cash, it means you're just holding the cash idly as it is without putting them into profitable areas, right? So high cash actually indicates investing inefficiency, right? So high level of cash indicates investing inefficiency. So basically high current ratio, not I can say high current ratio, but very high current ratio indicates inefficiency actually. Okay. So very high current ratio actually indicates inefficiency. So if you're talking of very high current ratio, if it indicates inefficiency, it can be the selling inefficiency, collection inefficiency, or investing inefficiency. Then, sir, tell us what should be the ratio. You're saying low current ratio means low liquidity, low level of solvency, which is not a good situation. If I'm having a very high level of current ratio, then you're saying, sir, it indicates inefficiency. So there has to be some ideal current ratio. So the ideal current ratio is basically 2 is to 1. Ideally, your current asset should be double that of the current liabilities. Ideally, current asset should be double that of the current liability. So therefore, we have this ideal current ratio to be 2 is to 1. Does it make sense, guys? Is the current ratio fundamental clear? Let me just have a look if there is any query. Okay. Anmol, no, current ratio cannot be in the form of percentage. It has to be always in the form of a ratio. Abhishek, you can just post your question once again at the end of our session. I'll answer it. It pertains to the previous session topic. I would request you to put this query at the end in the last 5-10 minutes. That time I'll answer your question. Okay, so there isn't any query as such, so we can now go for the next discussion. Now, suppose we have a current asset and current liability position of a company like this. The company has a cash balance, bank balance, short-term investments, debtors, stock, prepaid expenses amounting to 3 lakh. Creditors of 1,50,000, right? So over here, if I just want to compute the current ratio in this case, current ratio, can I say it is 3 lakh upon 1.5 lakh, which is 2 times. Current ratio is 2 times. 3 lakh upon 1.5 lakh, we get the current ratio of 2 times. So current ratio, if it is 2 times, it means it's a good situation. Company should be solvent enough to cover its expenses, right? Now let us say the creditors come to me and ask for, let us say creditors come to me and ask for their payment. How will I make payment to the creditors? How will I make payment to these creditors? First of all, we'll utilize this cash, which is 10,000, let's say. So we utilize this cash balance to pay. Then we will utilize this bank balance. Maybe we'll give a check to the creditor. We may even liquidate the short-term investments. We can sell off the short-term investments and get this value. And let us say this debtors, we can also insist on the debtors to give us bills. So we get bills receivable from the debtors, and let's say we are able to discount it. 30,000 is the face value of the bill. Let's say you are discounting it at 29,000. Even if you pay this, you still have got some balance outstanding that you need to pay. Now, what is that outstanding amount that we need to pay? It is 10, 5, 50, 60, 1 lakh, 1 lakh 29 is something you are able to pay. It means that 1 lakh 21,000 is still going to be paid. Now, how would the company really honor its obligation? So it means, how will you make the payment to the creditors? Can I say this is not possible? So here's a big blunder, sir. Even after current ratio being twice, even after current ratio being in a safe zone, what we are observing is, we're not able to honor the obligations, short-term obligations. So if we just analyze why is it so and why is it happening in that manner, what we can make a simple observation is, though current ratio was 2 times, but the problem was your current assets actually included certain assets. Your current assets actually included certain assets which were not worth enough to be used for paying the dues. Can I return the stock to the creditor? And I'll say that you take away the stock. I'm not interested in the stock. The creditor will, just lash out at me and say, why the hell you are looking at, why did you buy the stock from me then? If you just wanted to return it. Of course, we cannot return the stock, nor we can transfer the prepaid expenses to the creditors. The problem is these two expenses, sorry, not these two expenses, these two items of the current assets are essentially not something, which will be useful for settlement of the liabilities. And for that reason, we come up with another measure for better understanding of the liquidity, which is a quick ratio. So this quick ratio is also called as acid test ratio. Is also called as acid test ratio. Quick ratio, also said as acid test ratio. Now, what is this quick ratio? Quick ratio is basically quick assets upon current liabilities. It is quick assets upon current liabilities. So, what do we mean by quick assets? When we talk of quick assets, we simply do one thing. from the current asset, we eliminate the non-quick assets. What are the non-quick assets? Non-quick assets means those current assets which cannot be liquidated in a quick terms. So current asset minus, you can say, stock, and further subtract the prepaid expenses. And then we divide this by current liability. Okay. So current asset minus stock minus prepaid expenses. That's the current liability. That's divided by the current liability. It gives us the quick ratio. Now, this is somewhat better. At least we are considering only those assets which can be converted into cash in a very quick terms. A better and a more strict measure of liquidity is called as a cash ratio. The other name for cash ratio is absolute liquid ratio. The other name for this is absolute liquid ratio. Now, absolute liquid ratio is basically eliminating the debtor also from here, because not all debtors will be ready to give a bills of exchange in front against their outstanding amount, and that may again hamper our liquidity. So, cash ratio is basically looking at only those assets which can be easily converted to cash without loss in their value. Because if I want to convert the debtors to cash, I need to get it converted to bills, and then bills needs to be discounted. So that actually costs us. So that's where we say that cash ratio will be computed by taking it as cash plus bank balance. Okay. And it will also include the short-term investments or marketable securities. Okay. Short-term investments divided by current liabilities. You can also say this should be sir cash plus bank balance plus marketable securities. This divided by the current liability. So this is even more strict measure of liquidity. Now, what should be the ideal quick ratio or cash ratio, sir? Ideally, the quick or the cash ratio, you should be looking at 1:1, because if you have sufficient amount of cash and easily marketable securities, which is equal to the current liability, you are said to be in a very safe zone as. Okay. So let me see. So you didn't upload the last lecture notes. I have, but let me check after the today's session. Okay, there's a mistake. This should be 21,000. Correct, yes. Yeah. Okay, why stock and prepaid expense deducted? Because you cannot use them to pay to the creditors, right? So we are eliminating them. A proposed dividend doesn't come in the balance sheet. The proposed dividend doesn't come in the balance sheet. Proposed dividend is disclosed in the notes. As far as the new standards are concerned, you should be aware of that. Okay. Yes. What are in marketable securities? Parthasarthi, uh, marketable securities are those securities which you can sell it in the market easily. Maybe the shares or the government of India bonds or the treasury bills, all of them can be in the marketable securities. Okay, great. Now, apart from this short-term position of current asset, current liability, quick assets, or the cash ratio that we are looking at, one important question needs to be answered is this one. How do you check whether we have sufficient quick assets to meet the day-to-day expenses? We should be having sufficient quick assets to meet the day-to-day expenses, right? So for that, let me just give you an example. Suppose you have a cash balance with you. Check your wallet and you find that you've got a cash balance of 2000 in your wallet, and your expenditures per day is, let's say, 200 rupees. So your expenditure per day is 200. Uh, Cash balance is 2000, expenditure per day is 200. Can you tell me the number of days? Can you tell me the number of days for which you have sufficient balance? What is the number of days for which the cash balance is sufficient for you? What's the number of days for which the cash balance is sufficient for you? Can I say it is 10 days? Can I say you have got the balance in your account which is equivalent to 10 days of your expenditure, right? So if you're looking at this number, 10 days, we are talking of is the number of days for which you have got cash balance is equal to 10 days. So the cash balance that you have is sufficient enough to fulfill your requirements for the next 10 days. How did you get this 10 days, by the way? Can I say you got this 10 days as cash balance divided by expense per day, right? So instead of 10 days, if someone has got a cash balance equivalent to 20 days of expenditure, can I say that person is supposed to be more, liquid, or that person is capable of, more capable of, uh, that person is actually more capable of meeting its requirements. The capacity of the company to meet its expenditure on a short-term basis is high, right? Correct, guys? Yeah. So similar concept we are going to apply for the company also. So here we look at the basic defense interval. Similar to what we have got as number of days, we are going to be getting this basic defense interval also. Basic defense interval is actually a ratio of numerator with cash, bank, and marketable securities. And of course, this is going to include any amount of receivables which you have, which you are going to receive in a very near term. So cash balance, bank balance, marketable securities, and near term receivables divided by operating expenses per day. So remember, this is always going to be answered in days, like 10 days, 20 days, 210 days, 30 days. So higher this number of days, uh, better is the situation of the company to meet its daily expenditure. So basic defense interval, we have this denominator में operating expense per day. Now, how do you get this operating expense per day? Sir, what do you mean by operating expense per day? So of course, first of all, in the numerator, it should be operating expense for the entire year divided by number of days. So in the denominator, it's going to be number of days, number of days in a year. And what are the operating expense that we are talking of? We're talking of cost of goods sold plus selling expense that we incur plus the general expenses that we incur. Now remember, in cost of goods sold, in selling expense, in general expense, you might be having some amount of depreciation and amortization also. Now that depreciation and amortization is not something which is a cash expenditure, right? This is not something which you're paying in cash. So I need to eliminate that impact. So minus will have to do depreciation and amortization. going to subtract the depreciation and amortization. So daily operating expenses will have COGS plus selling expenses plus general expenditure minus the depreciation and amortization, because these are not a part of your cash expenditure, and therefore we are eliminating the depreciation aspect out of it. Okay. Does it make sense, guys, how to compute the daily operating expenses? And remember, basic defense interval higher is indicate, or higher basic defense interval basically indicates better capability to honor. Basic defense interval indicates better capability to honor day-to-day expenses. So here it is, higher the better. So better, if you're looking at a higher basic defense interval, it indicates you have sufficient cash to keep, or sufficient cash to meet your daily expenditure. Okay. What is the difference between quick ratio and quick ratio? Is just a ratio between asset and liability, whereas is how many days of balance you have, how many days of quick assets you basically have. Great, fine. So that is about the basic defense interval ratio. Now we can go for the next point of discussion. So let us say three companies, P, Q, and R. P has got an amount of owned funds to the tune of 10 lakh. It has got no borrowed funds. So total capital that it has employed in the business is 10 lakh. There is company Q, which has got owned funds invested of 5 lakh and borrowed funds invested of 5 lakh. Basically, total funds that has been invested in the business is 10 lakh. R is having a owned funds of 2 lakh, borrowed funds of 8 lakh. It means it has taken a loan of 8 lakhs. So total works out to be 10 lakh. So if you look at total capital employed, that is same for all three companies. Total capital employed is same for all the three companies. There's no distinction between them. Even the way the funds are employed, that is also same. Let us say in fixed assets, all of them have invested 6 lakh. P, Q, and R, all three have invested 6 lakh in fixed assets and 4 lakh in net current assets. The total investment is still 10 lakh. Okay. So only point of difference is the amount of debt and equity. Rest, the total funds employed in the business is same. The capital employed in the business is similar, 6 lakh in fixed asset and 4 lakh in net current assets. There's no difference at all. Now the question is, if you look at this simple summarized balance sheet, can you tell me which company is stable in a long run? Or can you tell me which company is actually having a long-term solvency away, or which company is having a higher long-term solvency? Yep. Which company has a higher long-term solvency? Can you tell me? Which company has got a higher long-term solvency? Company P, Q, or R? I'm getting most of the answers. Yes, P. Company P. Company P has got a long-term solvency. Now, why you guys are saying it? Because your owned funds is 10 lakh and borrowed funds is nil. So there is no loan. There's no loan at all in company P. And for that reason, the long-term solvency or risk in the company is lower, or solvency or stability in long term is supposed to be higher. Correct. So how do we really measure it in numerical terms? For that, we have got some sort of numbers over here. We have got certain ratios to look at when we want to really measure the long-term solvency. First one is the equity ratio or proprietary ratio. Equity ratio, proprietary ratio is computed by simply taking numerator as owned funds and denominator will be considered as the net assets. Now, what do we really mean by owned funds? If we just try to look at the balance sheet and we want to see what is owned funds is basically your equity share capital plus preference share capital plus reserves minus any fictitious asset. We have owned funds, preference share cap. In owned funds, we have equity share capital, preference share capital, reserves, and fictitious assets to be subtracted. And then divide it by net assets. Now, what do you mean by net assets? Net assets means your fixed asset plus current asset plus any investment that you have made in financial assets. And from that, you're going to subtract the current liability. Now, the question arises, sir, why are we subtracting the fictitious assets and what are these fictitious assets? Fictitious assets are basically those assets which cannot be sold in the market, which has got no value in the market, but they're still lying in our balance sheet. Like you have any preliminary expenses which has not yet been written off, right? Preliminary expense not written off, or discount on issue of debentures, discount on issue of shares. So all these are fictitious assets. They do have a debit balance, but they don't have any saleable value in the market. So that needs to be subtracted. So fictitious assets needs to be subtracted from the total fund, because the idea is whatever is your fictitious assets, like discount on debentures, discount on issue of debentures, discount on issue of preference share or preliminary expenses, they should have actually been debited to the P&L because they are expenditure, and those expenditures should have been debited or deducted from your profit balance, which you haven't done it. And for that reason, we are going to subtract fictitious assets from the reserves to arrive at the total figure of owned funds. So this number, owned funds upon net assets, it indicates us that out of total net assets, how much is funded by owned funds. So for example, if you get this equity ratio or proprietary ratio number as 0.7, so 0.7 means 70% of net assets of company are 70% of net assets of the company are funded by owned funds. They are funded by owned funds. Fine. Is it clear? 70% of your net assets are funded by owned funds, that is 0.7. Now, when we look at the next ratio, which is actually opposite of this, debt ratio. Now, debt ratio simply means total debt. Total debt means both your long-term as well as short-term divided by net assets. So here it indicates, suppose if your number over here, if the debt ratio number is, let's say, 0.3, it indicates 30% of net assets of company are funded by borrowed funds, or you can say these are funded by borrowed money. right? So that's your debt ratio number, guys. The debt ratio is, when we say debt ratio is 30%, it means you are going to be funding the total business to the extent of 30% by way of borrowed. Okay. Now tell me, if the equity ratio higher, the better it is, because safer it is. Lower, it means you are funding your business to a lesser extent by, by the owned funds, and that actually means it's a risky scenario. So if we just try to compute both these ratios for our example, in our example, let's say we are looking at calculating the proprietary ratio. Looking at to calculate a proprietary ratio. Proprietary ratio over here will be 10 lakh upon total assets, or the net assets, which is 10 lakh upon 10 lakh. It's going to be 1, because 100% it is funded by owned funds itself. And if you look at the second question, that is actually 5 lakh of owned funds out of total funds invested of 10 lakh. It means zero point 0.5. So 0.5 means 50% of the business is funded by owned funds. And in the last case, you'll say it is 2 lakh divided by 10 lakh. Now 2 lakh divided by 10 lakh is zero point 0.2. It means just 20% of the business is funded by 20% of the business is funded by the own funds. Okay. Now, if I ask you what will be the amount of debt ratio, here debt ratio will be 0 upon 10 lakh, because there is no debt in this. In the second case, it will be 5 lakh upon 10 lakh, which is 0.5. In the last case, it will be 8 lakh, because 8 lakh is the borrowed money out of total 10 lakhs, so that is 0.8. So higher the debt ratio indicates a higher risk and lower long-term solvency. Okay. Now, let's look at the next ratio, which is debt equity ratio. Now over here, debt equity. Debt equity means it is debt, as the name says. Debt equity means debt upon owned funds, or to be specific, equity funds. Okay. So debt upon equity funds, it indicates the debt equity ratio. So debt equity ratio, the analysis is, suppose for example, debt equity ratio is 1.5 is to 1. So it indicates for every rupee 1 of equity, company has rupees 1.5 of debt. It's a ratio between the borrowed money and the owned equity funds. That's the ratio for every 1 rupee of owned funds. How much is the borrowed money, or how much is the debt? That is what we mean by debt equity ratio. And remember, here debt includes both short term and long term. Okay. Are these three ratios clear to everyone? Are these three ratios clear to everyone? Okay, so let me look at the questions. In P0.5, do we need to take the net asset or total assets in the proprietary ratio? In the proprietary ratio, we take the net assets, because we are considering only the owned funds. Do we consider lease liability as a part of total debt or long-term debt? Yes, you need to consider the lease liability. Clear? Clear. Okay, fine. Now, there is some ratio called as capital uh, gearing. Before that, someone is asking me the debt equity is not clear. Debt equity is simply the ratio between the borrowed money and your equity funds. So higher the debt equity ratio, it means more debt you have taken as compared to equity. So it indicates a risky scenario. In debt ratio, what is included in equity funds? In equity funds, you will have your equity share capital, reserves minus fictitious assets. Yes, Anmol, you are right. Everything will be fixed. Okay. Now the one common asked question is debt equity ratio will or any of these ratios. Is there any ideal ratio? No, there's no such ideal ratio because it depends on companies' earning capability. Okay, so it depends on companies' earning capability and a lot of other factors depends on industry to industry, and therefore we are not looking at any ideal ratio as such for them. Okay, so debt ratio, uh, the equity in market price or face value. Gunjan, equity will be the face value plus the reserves because equity funds over here, it means equity share capital plus reserves minus fictitious asset. Okay, and one thing is over here, yeah. In case of debt ratio, this is going to be divided by the total assets, not the sorry. Yes, so considering both of um, hmm. Over here, debt ratio was a query. Ideal ratio, there's no ideal ratio as such. Equity funds means only equity share capital. Yes, equity share capital and reserves. In study material, it is taken as total assets. What are you talking of? Total assets? In which ratio? In the equity ratio? Proprietary ratio? Yeah, over here you're saying total assets. Correct. Yeah. True. So this is going to be divided by total assets. Correct. Total assets, or it is sometimes also taken as net assets that will be given in the question. You need not worry about. And even in case of debt ratio, it will be total debt upon, you can take even total assets. Okay. And so you can have net assets as well as total assets, but generally you use the term in total terms itself. Sometimes even the question may say you take it as a net basis also. That is fine. Okay, so let's talk of what do you mean by capital gearing, because we need to first understand what is capital gearing to understand the ratio of capital gearing. So with regards to there shouldn't be any confusion. It can be total assets or net assets, depends on what is required in the question. If the question asks you to compute the equity ratio on a net asset basis, you take the denominator as net asset, or you can even take it the total asset basis. So the question will clarify about that. You need not worry about that aspect. Okay. Now let's focus on the next part, which is what do we mean by capital gearing? Because we have this ratio of capital gearing over here. So we need to know what is really capital gearing. So capital gearing is, let us say three companies. Let's say we have got three companies, PQ and R, own funds. to the tune of 10 lakh. 1 second, guys. Yeah. So let us say owned funds to the tune of 10 lakh for company P. It has got a borrowed for money of zero and the total is 10 lakh. Q has got a owned funds of 5 lakh, borrowed money of 5 lakh, totaling to 10 lakh. R has got a owned fund of 2 lakh, borrowed money of 8 lakh, and total amount is 10 lakh. Now, let us say the three companies are into the same line of business. So, of course, if they are into the same line of business, they will be generating income also similar before interest component. So, before you pay any interest, your earning should be same if you are into the same line of business, same set of customers, and everything remaining same. So, let's say earnings before interest and tax. Earnings before interest and tax. Over here, you have it as for all the three companies, it is same, which is let's say 3 lakh. Because if they are into the same line of business, EBIT is also supposed to be same, which is because this is the earning before interest. So that's same for all the three companies, 3 lakh. Less interest will be, in the first case, it's going to be nil. But for the second case, you have a borrowed funds at the rate of 10%. So for 5 lakh, you have the 10% rate. So that amounts to 50,000. And for 8 lakh, you have 10% rate, which amounts to 80,000. Now the PBT, or let's say the profit before tax figure, we'll say it is 3 lakh, but for Q, it's going to be 2 lakh 50,000, and for R, it will be 2 lakh 20,000. Now, suppose taxes are paid at the rate of 30%, will pay 90,000 as far as P is concerned. For Q, it will be 75,000. And for R, it will be, let's say, 66,000. Yeah. So your profit after tax figure for company P is going to be 2 lakh 10,000. For company Q, it is 1 lakh 75,000. And for company R, it is 1 lakh 54,000. So for PAT, we can say it is 2 lakh 10, 1 lakh 75, and 1 lakh 54,000 of profit after tax generated by the three companies, P, Q, and R. Now, if I ask you, looking at this, which company has performed better? What will be your answer? Which company has performed better? Yeah. Which company has performed better? Company P, P, A, R has performed better. Fine. A. Majority of you are saying that company P has performed better. Uh, Here, Instead of saying that a typical company has performed better or not, um, let's look at simply another aspect. Let us say similar things are there. Okay. But the thing is now, the capital structure, let me just take it as similar. Let's say capital structure is similar, 10 lakh being the total capital employed. Now we look at the EBIT figures. The EBIT figure, let's say now if it is 90,000, if it is 90,000, can you guys just calculate and tell me what are the PAT figures for all the three companies quick? Come on, guys. Calculate the PAT figure, the profit after tax figure for all the three companies. If we take the EBIT figure to be 90,000, if the EBIT is 90,000, compute the amount of PAT. Yeah, compute the amount of PAT, guys. So as we see, interest will be nil. Here the interest will be 50,000. In the next case, interest will be 80,000. Now, PBT is 90, 40, and 10,000. Taxes, we're taking it as, let's say, 30%. So 27,000. 30%, it means it should be 12,000. Here it will be 3,000. So PAT figure will be 53,000, 28,000, and 7,000. So PAT figures are these three numbers. Okay, so profit after tax figures 63, 28, and 7,000. Now the question is similar from my end. Which company has performed better? Now you cannot be absolutely looking at your profit after tax figures and just say that which of the companies have performed better. Rather, we should be looking at one important aspect, which is what is the return on equity which the companies have generated. What is the return on equity which the companies have generated? Return on equity means what? What do you really mean by sir, return on equity? Okay. Return on equity is simply, if I ask you, for company P, what is the investment by equity shareholders? Sir, 10 lakh. What is the earnings that the company has made for its equity shareholders? That is 2 lakh 10,000. So here, if we compute the return on equity, it is essentially 2 lakh 10,000 is the earnings on an investment of equity shareholders of 10 lakh, which comes out to be 21%. What do you mean by return on equity? Return on equity is basically computed as PAT upon equity shareholders funds into 100 because returns are generally in terms of percentage. So company P has actually given a return of 21%. The company Q has given a return of 1,75,000 on not on 10 lakh because for the second company, the investment by equity shareholders is only 5 lakh. It's not 10 lakh. From the equity shareholders perspective, it is 5 lakh. And if you compute this, this works out to be 35%. And in the next case, 1,54,000 on an investment of 2 lakh. That works out to be a percentage of 77%. But obviously, this is the company which has performed well in the first case. In the second case, if we just go ahead and compute the return on equity, If we compute the return on equity, it is 63,000 upon an investment of 10 lakh. That is like 6.3%. If you look at the second case, it's a return of 28,000 on an investment of, what is the investment by equity shareholders? 5 lakh. Upon 5 lakh, that works out to be a return of maybe you can say 5.6%. And last, it is 7,000 on an investment of 2 lakh. So that is a meager 3.5%. So obviously over here is the first company which has performed better. Now, why is it so that when your EBIT was 3 lakh, it was company R which was the best one? And why is it that when your EBIT is 90,000, company P turns out to be better? Why is it so? What is the reason for that? The reason lies in another ratio called as return on capital employed. We need to know, though the company has given some percentage return to the equity shareholders, what is the rate of return that the company has generated for the entire business? So return on capital employed is basically, we calculate total capital employed in the denominator, which is the total funds that the company has employed or invested in the business, and on that how much the business has given. Now whatever is the earnings of business, that is basically EBIT, or earnings before interest and tax is the EBIT figure, earnings before interest and tax. This figure is actually an indication of what is the return the business has given on its. After that, the pictures change because you need to give the funds to the fund providers. But be it any type of business, it is giving you it's going to give you some sort of return. And here, since we have assumed that all the three companies are into the same line of business, EBIT is going to be a same number for all of them. So in the first case, if you look at this, you are actually generating 3 lakh on a capital employed of 10 lakh, which is 30% for all three of them. This is essentially 30% for all three of them. So the idea is, you have invested in a business which is giving you 30% return, and you have borrowed money at 10%. So obviously it's going to be an advantageous situation because your cost of funds is lesser than the rate of return on the investment. So cost of funds is just 10%, whereas your business is giving you 30%. So it is obviously a better thing that if you take more and more debt, that will give you a higher return on it. Now let me just explain it in a better way. Now suppose I'll take the case of R Limited. Or let's say R Limited. Total capital employed was 10 lakh, right? Now this 10 lakh, we can distribute it in two parts. Some amount is raised as equity, some amount is raised as debt. Equity is, let's say it was 2 lakh and debt was 8 lakh, right? Remember, debt was having a cost of 10%. Now, since your business was giving you a return of 30%, from wherever you bring the money, be it equity or debt, it is going to give 30% return. So on 2 lakh, you're actually earning 60,000, and on that 8 lakh, you're earning 2 lakh 40,000. On 8 lakh, you're earning 2 lakh 40,000. interest, I need not pay any interest on my own funds because I need to pay interest on this 8 lakh. So interest on this 8 lakh is paid as 80,000. So basically your profit before tax, your before tax figure is 1,60,000 over here and 60,000 over here. Tax values, uh, it was 30%. So over here you're paying a tax of 18,000 and here you're paying a tax of 48,000. So the PAT that is generated, profit after tax that is generated on the owned funds is 42,000, and on borrowed money you're generating a profit after tax of 1,12,000. In totality, your PAT turns out to be 1,54,000. You got a distribution. So this 1,54,000 is a result of normal 42,000 return from my business and additional surplus return which we have made from the debt fund. Now this surplus is possible because you are having a cost of 10% and you're getting a return of 30%. So return on equity in this case, as we observe, return on capital employed is higher than cost of debt. And this actually leads to favorable situation because you are getting money at 10%, but you're investing at 30%. You are getting a higher return. Because if you see PAT figure is a combination of normal return which equity shareholders get of 42,000 and surplus return of 1,12,000. But why is it not working over here now? Because in this situation, if you look at this EBIT figures, here the return on capital employed is just 9% because on an investment of 10 lakh, the business is earning 90,000. On an investment of 10 lakh, the business is earning 90,000, which is 9% return on capital employed. So that's 9% return on capital employed, whereas your cost of funds was 10%, guys, right? Your return on capital employed business was giving you 9% return, whereas you have borrowed at 10%. So now the things are going to be not in your favor because you have borrowed at 10 and investing at 9%. The extra 1% shareholders need to pay from their own pocket. It will be the expenditure of shareholders. So it means taking debt is beneficial only if return on capital employed is greater than cost of debt. Right? Now, this concept is what we call it as capital gearing. Now, it means taking debt or taking fixed cost capital is actually useful only if your business is growing or it is functioning at a faster rate. If the business is functioning at a slower rate, capital gearing is not going to be useful to you. Now, this capital gearing concept, you have it from the gear system of automobiles, where how many of you are really aware of driving, not that of a scooty, but any geared vehicle, be it a okay, does this mean performance of equity share? Will you sharing this working notes? Yes, I'll be sharing it. Okay, you those who are aware of driving, you might be aware that to achieve a higher gear, maybe the third or the fourth gear, uh, you need to you know uh, be at a particular speed. At lower speed, you cannot have high gear. Right, the same fundamental over here. If you want to have a high gear in the form of borrowed funds, you need to have a high level of return on capital employed, or EBIT should be very strong. Right? So in bike also or in a geared vehicle, if you just drive it, if you're driving at let's say 30 or 20 speed, can you just increase the gear to the fourth gear? It's not possible, right? So high gear is needed for faster speed. So over here, our speed is the return on capital employed, which is the reflected in the EBIT. So if this speed is higher, then it is favorable to take borrowed. If it is not higher, better to go for lower gearing or better to invest more into the owned funds itself. Okay. So that's where this capital gearing ratio is. Capital gearing ratio is simply the ratio of uh, fixed cost fund. It's the ratio of fixed cost funds upon non-fixed cost funds. Now, what do you mean by fixed cost and non-fixed cost? Can you tell me which are the types of funds on which you need to have, or on which you need to pay a fixed cost of fund? Obviously, all your debt as well as preference share capital. So both debt as well as preference share capital require fixed cost, and the denominator is non-fixed cost funds is basically equity share capital plus reserves minus fictitious assets. Right? So in the numerator, we'll have the debt and preference share capital, which are the fixed cost funds, and then you divide it by the non-fixed cost fund, which is the equity share capital plus reserves minus fictitious assets. And we know this entire part is said to be equity shareholders fund. Okay, so capital gear is the ratio between that numbers, and this gearing, if it is higher, it is beneficial only if your only if the speed is higher. Now, what do you mean by speed? The speed is basically reflected in the EBIT figures or the return on capital employed. Okay, guys. So this is what we have seen at capital gearing ratio. I hope capital gearing ratio is pretty clear about it. Now, we have seen some of the ratios about the long-term solvency. We still have to see certain more ratios, which we will take it up after a short break right now. Let's take a break of 10 minutes, guys, and post that we will continue with some more ratios to be discussed. Okay, let's have a break, guys. See you soon. Okay. Welcome back, guys. After the break, let me see if there are any queries. What is PSC? PSC is preference share capital. And I want to make one request. Please upload mock test papers earlier this time. More in numbers, at least 5 mock papers. Okay, fine. No such specific queries. Oh, so last session, just before the break, what we have seen is capital gearing ratio as a simple ratio between the fixed cost funds and non-fixed cost funds. All these numbers were actually indicative of uh, the risk, solvency, uh, or the stability of the company in long term. Okay, so let me just summarize all the three in as far as conclusions are concerned. Let us say proprietary ratio, ratio, debt equity, and capital gearing ratio. What are their implications as far as long-term solvency is concerned and risk is concerned? A high proprietary ratio indicates that long-term solvency is higher, and also it indicates that the risk is lower. High debt ratio indicates lower long-term solvency and higher risk. Debt equity ratio, if it is higher, it means proportion of debt is more than equity. So that indicates a lower long-term solvency and also a higher risk. Capital gearing ratio, if it is higher, it means you're taking more fixed cost funds, then your long-term solvency will be lower and the risk is going to be higher. So all the four ratios work in tandem to let us know how the company is basically positioned at as far as long-term solvency is concerned. Now, let's answer another question. Long-term solvency not only should be the ratio between the owned funds and borrowed funds, or some other ratio between fixed cost and non-fixed funds. Rather, it should be also considering the ability to pay dues on time. The ability to pay dues on time. Now, how do I measure that ability? So for that, let me just take an example. Let's say there are three individuals. Okay, so we have got three individuals, X, Y, and Z. Suppose they've got a salary. X has got a salary of 1 lakh. Y has got a salary of 50,000. Z has got a salary of 60,000. And we have a, let's say they have got a EMI, monthly EMI which they have to pay. 20,000 is the EMI for each one of them. 20,000 is the EMI for each one of them. Can you tell me uh, which of these three persons are actually more able or capable to pay the dues? All the three persons, XYZ, we have the salary and the EMI numbers available for you. Which person can we say that is in a safe situation of paying the dues? Which person is more safe? Can I say it is X? Because let me just calculate why it is X. For that, a very simple number needs to be computed. We'll simply say how many times of EMI is salary. So we're just looking at how many times of the EMI is the salary. So EMI is 20,000, salary is 1 lakh. So how many times of EMI is the salary? It means over here for X, it is actually 1 lakh being the income and EMI being 20,000. So that is actually 5 times. So this guy's income, Mr. X income, is 5 times of his EMI. As far as Y is concerned, it is 50,000 divided by 20,000, which is 2.5 times the EMI. And for Z, it is 60,000 divided by 20,000. That comes to 3 times the EMI. So, of course, X has got a better cover because whatever is his income, that is covering EMI to the extent of its 5 times. So, better the cover, higher is the capability of the entity or the person to honor the obligations. Am I right, guys? Correct? Right. So, this particular cover is computed using certain ratios that we are going to look at now. So, the first ratio that we are looking at is interest coverage ratio. So, interest coverage ratio tells us how many times of interest is EBIT. Interest coverage ratio tells us how many times of interest is the EBIT. Interest coverage ratio tells us how many times of the interest is EBIT. So we can say interest coverage ratio is EBIT upon interest. So we can say compared to interest, what is the quantum of the EBIT? So if your earnings before interest and tax, ideally it should be more than interest. Whatever is your earnings before interest and tax, that should be ideally more than the interest. Then only it makes sense to keep something on debt, right? So interest coverage ratio is EBIT upon interest, which is telling us whether we are able to really cover the interest. Similarly, preference dividend coverage ratio. This is computed as profit after tax because to pay preference dividend, what we need is profit after tax. To pay preference dividend, what we need is profit after tax. So profit after tax upon preference dividend. This tells us how many times of preference dividend is profit after tax. Obviously, higher the number, better it is. Okay, so these two are the simple coverage ratios that we're talking of as far as interest payment is concerned and as far as the preference dividend is concerned. Similarly, we may have fixed charge coverage ratio and debt service coverage ratio. So fixed charge coverage ratio is computed as EBIT plus depreciation. Now, why are we adding back the depreciation, guys? Because depreciation is, we are adding back depreciation because depreciation is a non-cash item. So it's not an expenditure that we're paying out of cash. We just add back the depreciation. And fixed charge coverage ratio, it includes interest plus principal payment due. Whatever is the amount of principal payment due, that is considered in the denominator. Remember, in interest coverage ratio, you are just checking how much interest is covered. In fixed charge coverage ratio, you are checking whether the earnings or cash flows are sufficient for repayment of principal also. Okay. Now, debt service coverage ratio is a bit more technical term, wherein we take the numerator as earnings available for debt service. Numerator is earnings available for debt service divided by denominator remains the same, interest plus principal due. Denominator remains the same, but numerator we say it is earnings available for debt service. Now, how do we really compute the earnings available for debt service? That is quite interesting. So how do you determine what is the earnings that you have available for debt service? So for that, here it is computed as whatever is your PAT, we add back non-cash items like the depreciation or amortization we add back. Plus we also add back the interest plus or minus other adjustment. Now, other adjustment means you can say these are basically non-operating items. All your non-operating income, non-operating expenses needs to be eliminated. So in the numerator, we have the earnings available for preference for a debt service. Now, what is the earnings available? It means basically how much cash do you have for debt service. So that will be your PAT, non-cash items add back, interest add back, and plus or minus any sort of other adjustments. Okay, so let me just make it a bit more clearer. Profit after tax, when you add back non-cash items, you're actually looking at only the cash earnings. And when you add back interest, because interest is something which I have to pay. So after interest figure, I cannot take in the numerator because I need to check what is the total amount that I have to pay to the debenture holder or the banker. So for that, I need to add back interest. And all these non-operating items needs to be eliminated because non-operating items are not sustainable. They are not maintainable in future. In one fine year, you may get some non-operating income, some non-operating expense may incur, but that cannot be looked at from a future perspective, and therefore non-operating item needs to be eliminated while we are computing the earnings available for debt service. So essentially, this gives us a number which tells us what is the amount that you have in the bank, from which you are going to pay the interest and the principal amount. Does it make sense, guys? Yeah. See, there's a query. Can we say earnings available for debt service is equal to EBIT? Earnings available for debt service? No, you cannot say this as EBIT. Anmol, you cannot say this as EBIT because it's a different adjustment altogether. Because in EBIT, your depreciation is subtracted, so depreciation needs to be added back. And of course, yes, you can say that it is EBIT plus depreciation. Okay. And also plus or minus other adjustments you can say, which is the non-operating aspect. In all the previous three ratios, we are not excluding the non-operating items. But when you calculate the debt service ratio, you remove the non-operating items from here. And of course, the tax payment is also taken into account because you take PAT. So basically, if you want from this figure, you want to obtain this. From this, you need to subtract the tax. Okay, and also plus or minus the non-operating expenses. Okay. Why do we add non-cash item? Because that is not something which you are paying out. You need the cash that is available in your bank account from which you will be paying your interest and principal. So you are actually looking at by what amount my cash balance or bank balance is increasing in a year. Okay, so what's the difference between fixed charge and debt service coverage? As I said, in fixed charge, you are considering the before tax item. In debt service coverage ratio, you are considering the after tax, and also in fixed charge, there is no adjustment for non-operating, whereas in debt service, you are having the adjustment of the non-operating items also. Why do we add back non-cash items? Because these are something which are not paid in cash, so therefore they are added back. Why do we add the add or less the non-operating items? Because they are something which are not maintainable in future. For that reason, we need to remove their impact. So that's the debt service coverage ratio, guys. Okay, the difference, I'll just recap. In interest coverage, it's just EBIT upon interest. No adjustment for depreciation, non-operating, nothing. Preference dividend is just PAT upon preference dividend. In fixed charges coverage ratio, we give an adjustment for the depreciation component. Debt service coverage ratio is even more precise, which takes into account the after-tax earnings available, and also the non-cash items are adjusted and non-operating items are also adjusted to look at the maintainability of the profits. Okay. What is the purpose of calculating these four ratios? This is to check whether the company is capable of paying its dues. Logic behind different ratio like fixed cost and debt service. fixed cost, where it is. It is fixed charges. So perspective is different as far as earnings is concerned, how better you are. Debt service coverage ratio is looking from the cash perspective. Ashok is asking, what do you mean by debt service? Debt service means what you need to pay to service your debt. It means to keep your debt in a standard condition, what you need to pay, what you need to service. So basically, you need to pay the interest and the principal due. How do you whether to decide add or less non-operating items? Who is this? Rachesh. Since we are taking PAT, from this you will remove the non-operating expenses. Sorry, you will add back the non-operating expenses and remove the non-operating items, because whatever non-operating income you have as of now, that is not something which you will receive in future. So even from current profit, you need to remove it. And what non-operating expense you might have subtracted, you need to add it back. Okay, fine. Now let's look at the next aspect, which talks about along with the short term and long term solvency, you also need to check the efficiency of the company, whether the company is efficiently utilizing its assets. So how do we go about checking the uh, well, so we need to check the short term, apart from just short term and long term the solvency. We need to check the efficiency. It means whether the company is efficiently utilizing its assets. So how do we go about checking the efficiency? So let's take an example to understand it. Let's say a company A is having a sales of 12 lakh. Another company B is having a sales of same 12 lakh. But the assets employed by the company A is 4 lakh, and assets employed by company B is 6 lakh. So by putting an investment, or putting an instead of saying asset, we can say investment also, right? On an investment of 4 lakh, A is able to generate 12 lakh sales. B is able to generate 12 lakh sales on an investment of 6 lakh. So which of these two companies are efficiently utilizing the assets? Can you tell me which of these two companies are actually efficiently utilizing the assets? Which of these two companies are efficiently utilizing the assets? Is it company A which is utilizing the assets in a better way? Yeah. Which of these two companies are efficiently utilizing the assets, guys? Is it company A? Yeah, perfect. It's company A. So how do you decide whether a company is utilizing its assets to the best possible way? For that, you have to compute some ratio called as an activity ratio. Now, the activity ratio is simply how many times of investment Hmm. So how many times of investment is sales? So basically this is three times and two times. Company A is three times of the investment, or so the company A is having a sales which is equal to three times of the investment value. B is having a sales of two times of its investment value. It means the company is utilizing this investment three times in a year, whereas company B is utilizing it for two times in a year. So of course, the better thing is company A, right? Okay. So based on that, we have certain turnover ratios. Turnover ratios are almost on the similar format. So you have the total asset turnover as sales or COGS, whichever number is available. If COG is available, COGS or sales. The question will specify, the numbers will specify on what basis this turnover is calculated. So sales upon total assets. This tells us how well we are utilizing the assets. This question, this ratio is going to tell us how better or efficiently we are utilizing total assets of the company. Similarly, fixed assets turnover will tell us how efficiently or well we are utilizing the fixed assets of the company. Capital turnover, it's basically how well you are utilizing the overall capital employed in the business. Now, total capital employed will be owned funds plus the borrowed funds. It means equity share capital plus reserves plus preference share capital minus fictitious asset and plus borrowed funds. When you add all of them, that's your total capital employed. So that's the capital turnover basically tells us how better your total investment in the business is being utilized. Current asset is going to tell you how effectively, how efficiently your current assets are utilized in business. Working capital is going to be on the similar format. Working capital, we know it is current asset minus current liability. So all these ratios are telling us whether we are utilizing the assets in the best possible way, whether we are utilizing the asset in the efficient way. Okay, all these turnover ratios are activity ratios. This tells us how active the business is, how efficient the business is being run. Okay. Now we have certain turnover ratios which have got a different interpretation altogether and a different scheme altogether. So let's look at one such ratio called as inventory or stock turnover ratio. Now I'm not looking at formula as of now. Let me just understand this with the help of numbers. Let us say a company has got a COGS of 12 lakhs. Company has got a COGS of 12 lakh, and on an average, it maintains a stock of 3 lakh. With the COGS of 12 lakh, the company maintains an average stock of 3 lakhs. Now, if I ask you, how many times in a year company sells one lot of stock? How many times in a year company sells one lot of stock? Tell me, guys. If your entire year COGS, cost of goods sold, is 12 lakh, and on an average you're keeping a stock of 3 lakh. If entire year COGS is 12 lakh, average stock is 3 lakh, in a year, how many times are you selling this 3 lakh stock? Because this 3 lakh stock is basically one lot of stock that you have. So how many times in a year are you selling this 3 lakh stock? How many times in a year are you selling this 3 lakh stock in a year? The answers. Four times, perfect. Four times, guys. So basically, stock turnover ratio is COGS upon average stock. It simply means uh, 12 lakh divided by 3 lakh, because by keeping a stock of 3 lakh, you're able to generate a sale of 12 lakh. So it means your sales is actually four times of the average stock, right? So this simply means sales is four times of average stock. Sales is four times of the average stock. Okay. Now, if there is another company, let's say company Z, which has got a stock turnover of suppose six times. Tell me which company is more efficient? Is our company with a stock turnover of four times efficient, or is it company Z with a stock turnover six times efficient? Which company is more efficient? Is it the company with stock turnover of six times, or is it ours with four times? Of course, six times. Of course, it is a company with six times turnover, which is more efficient, right? Company with a stock turnover six times more efficient because it is utilizing its assets in a more efficient manner. Now, a question to you is, uh, sales is four times of our average stock. So we find that over here our stock turnover is 12 lakh divided by 3 lakh, which is four times. So stock turnover is 12 lakh divided by 3 lakh, which is four times. Now, my question to you is, how many months does it take to? My question to you is, how many months does it take to sell one lot of average stock? To sell one lot of average stock, how many months is the company taking? What is the number of months taken by the company to sell its one lot of stock? Can I say in a year you are selling it four times? So in entire lot of 12 months, you're going to sell the stock four times. This means, can I say every 3 months the stock is being sold? It's like you start with the month and zeroth month one. So every three months you are going to sell it. So the sale months are going to be like month 3, month 6, month 9, month 12. You have a sale in third month, in sixth month, in ninth month, and in 12th month. So four times you are selling, but the time gap between two sales is 3 months. And this 3 months that we computed is said to be stock holding period. By the way, this is also said to be stock velocity. Just one and the same meaning. Stock holding period or stock velocity is just one and the same thing. So the idea is holding period or stock turnover. If your stock turnover is higher, holding period will be lower. Okay. Green has got frozen. Some technical issue. Let me just share the screen. Yeah, yeah. So, if your stock turnover is higher, the stock holding will be lower, right? So, let's say if your stock turnover, in our case, it was 4, so we said stock holding period was 3 months. If you take stock turnover as, let's say, 6 times, it means you're holding stock for just 2 months. If your stock turnover is 12, so in a year you're selling it 12 times, it means you're actually holding the stock for just 1 month. And if that's the case, if that's the case wherein the stock turnover is higher and stock holding period is lower, it means it indicates higher level of activity. Okay. Now, similarly, we have receivables turnover, which indicates how efficiently or how actively we are selling the goods to our customers. So, receivables turnover, we compute it as credit sales upon average accounts receivable. Accounts receivable. Now, what do you mean by average accounts receivable? Average accounts receivable simply means average debtors plus average bills receivable. Average debtors plus average bills receivable. You can get the average figures as just picking opening and closing figure, nothing difficult. Now, if you look at the numbers, suppose our credit sales are again,
Recording in progress.
yeah, this will make things much better now. Okay, so suppose credit sales is amounting to 24 lakhs, okay, and we have a average accounts receivable. Average accounts receivable is, let's say, 8 lakh. Can you tell me how many times in a year we are selling goods to customers? How many times in a year are we selling goods to the customer? Because if your average debtors is 8 lakh and your credit sales is 24 lakhs, your average debtors is 8 lakhs and sorry, average sale debtors is 8 lakh, credit sales is 24 lakh. How many times in a year are we selling it? Can I say it is just 24 lakhs divided by 8 lakh? That works out to be 3 times, right? So if it is 3 times, can you tell me what will be the debtors collection period? It means in how many months you're actually collecting money. It's 12 by 3, which is 4 months. 12 by 3, which is 4 months. Right? So debtors collection period is 4 months. Is also said to be debtors velocity. Now, of course, higher the debtor turnover ratio, better you are at managing your debtors, because then higher receivables turnover indicate lower debtor collection period, and that will ultimately add to uh, lesser amount of debtor in your balance sheet, which will again show a collection efficiency. Okay. Similarly, we have payables turnover, which is credit purchases upon average payables. Credit purchases upon average payables. Now, what is average payables? Average payables is the average of creditors and average of bills payable. Again, it indicates how efficiently, how quickly you are paying to the creditors. Now, the next parameter of ratio is how do we check if the company has generated adequate profits or not? Now, to check the adequate profitability, there are 4 parameters to be looked at. One is you do it on the basis of sales. So your profitability parameter may be based on sales. Second is maybe the profitability parameter is based on return on investment. In some amount which you might have invested, uh, on that how much return you are generating. Third is based on return to the owners, and fourth is based on the markets, based on market investors. Okay, so 4 parameters are something on which we have the profitability ratios. Now, on which we have certain very easy ratios to look at. First is gross profit ratio. So how do we compute the gross profit ratio? Remember, all the ratios which are based on sales, they're always of the type X upon net sales, because we are looking at it as a percentage of sales. That what percentage of sales is the GP that you're earning, what percentage of sales is the net profit that you're earning. So GP ratio is simply gross profit upon net sales into 100, because all the return ratios, remember, all the profitability ratios are always going to be in expressed percentage terms. All the return ratios, profitability ratios are going to be in percentage terms. Net profit ratio will be simply net profit upon net sales into 100. Operating profit ratio, remember, operating profit is simply your EBIT. Operating profit is EBIT upon net sales into 100. Now, how do we get this EBIT figure, by the way? EBIT is obtained as sales minus COGS minus any operating expenses. Now, operating expenses means what sort of operating expenses are we talking of? Because COGS is cost of goods sold. Operating expense includes some more expenses. Now, that some more expenses are basically operating expenses. It includes your administrative expense, which is office and admin expense, and also it includes selling and distribution expense. So we have certain expense ratios also, because when you look at profitability ratios, we need to also consider certain expense ratios. Now, expense ratios that we can refer is, one is the COGS ratio. Now, as the name says, COGS ratio is COGS upon net sales into 100. Similarly, operating expense ratio, because as I said, all the ratios are of the format in this way itself. So in the numerator, you'll have operating expense upon net sales into 100. Then you may have operating ratio. Remember this, we are not talking of operating expense ratio, we're talking of operating ratio. Operating ratio is the expense that you incur for operating the business. Now, to operate the business, you need to incur COGS and also certain operating expenses which is going to be upon net sales into 100. EOGS, operating expense, operating ratio, are some of the expense ratios. Now, the next aspect which we need to cover is how are we going to measure the percentage return on investment. So, like for example, if your investment is 10 lakh, and on that investment you have generated an income of, let's say, 2 lakh. So what will be the rate of return on investment? Rate of return on investment will be 2 lakh divided by 10 lakh in 200, which is just 20%. So rate of return on investment will be 20%, right? So the easy way to calculate the rate of return on investment is income upon investment into 100. Okay, so categorization, we have return on assets, return on capital employed, and return on equity funds. When we look at return on assets, what are we really including in it? Return on assets. Return on assets, our investment is the assets that we have acquired. Okay, return on investment is the assets, the total assets we are talking of. Okay, and on the total assets, what we have earned is basically EBIT. Okay, return on total assets, which if it is stating that you need to compute the after tax, you will multiply it with 1 minus T. Okay, sometimes the question may also ask you to calculate the return on assets on a net basis. So you will say EBIT upon net assets. Return on capital employed and return on equity is what we have already computed. Return on capital employed is basically earnings before interest and tax upon average capital employed. Now, average capital employed will be the equity shareholders funds plus borrowed funds plus preference share capital in average terms. Now, how do you get the average? Simply the average of opening and closing funds. On equity funds, this is what we have already computed. It is basically net profit for equity shareholders upon equity shareholders funds. That's the return on equity, right? The return on equity funds is computed in this way. Now, certain ratios which are based on market. We look at those market ratios now. Market ratios. So let us say a company has got a net profit for equity shareholders as 10 lakh. And let's say the company has got a total number of equity shares as 1 lakh. Can you tell me what is the earnings per share of the company? What is the amount of earnings per share of the company? Can I say it will be net profit for equity shareholders fund divided by number of equity shares? So earnings per share will be total earnings divided by number of shares. That's pretty simple, right? So that is 10 lakh upon 1 lakh, which works out to be rupees 10. You have earnings per share. Now, out of this earnings, let's say company has paid out certain amount as dividend. The company has paid out certain amount as dividend. Let's say out of total 10 lakh earnings, company has paid out 4 lakh as dividend. So can you tell me what is the dividend per share? Dividend per share will be net profit for, not net profit. Dividend per share will be total dividend divided by number of equity shares. Total dividend divided by number of equity shares. So total dividend is 4 lakh upon number of equity shares of 1 lakh, which is 4 rupees. Now, if I ask you, out of its earning, what proportion is paid out by the company as dividend? That's a dividend payout, right? Out of 10 rupee earning, the company has paid out 4 rupee as dividend. So proportion wise, you can say it is 4 out of 10, which is 40%. So this tells us what proportion of earnings is paid out as dividend. That's your dividend payout. Then retention ratio. So if 40% is paid out, what is left over? You will say out of 100%, 40% is paid out. It means 60% of the money is retained. So how do we get this 60%? It will be like simply the earnings of 10, out of which 4 rupees paid out as dividend. So out of total, 6%. So this is telling us what proportion of earnings is paid out. Sorry, what proportion of earnings is retained by company. Okay. Uh, After this, we have the ratio of P ratio and dividend yield and earnings yield. So let's first talk of earnings yield. If based on this information, I tell you that market price per share is rupees 100. So if someone who would have bought the share for 100 rupees and if he is being shown a return of 10%, what is the yield? What is the return that he has got? That's what we call it as earnings yield. Earnings yield will be EPS upon NPS into 100. So EPS is 10 on a market price of 100 rupee, which translates to 10%. Then if you look at dividend yield is dividend per share upon market price per share into 100, which is 4 rupees dividend on a share price of 100. So that translates to 4% as the dividend yield. So yield is basically based on market price, what is the rate of return? Okay. One ratio last that we have for today is something called as P ratio or price to earning. Let's say there are two companies, A and B. EPS of A is 10, EPS of B is also 10. But market price of A is 120 and market price of B is 80. So what is a P ratio? P ratio is basically price to earnings. Price divided by earnings. So ratio is NPS upon EPS. So over here it is 12 and it is 8 and it is always measured in times. P is always measured in times. We have P ratio as 12 and 8. So remember, this P ratio is actually a measure of confidence of investor. Investors are ready to pay a higher price for the shares of the company if they have really confidence on. Like people will pay a more price for iPhone as compared to Redmi or Vivo or Oppo with the same features. Even if the phone has got the same features, still people are ready to pay a higher price for Apple because they have a greater confidence on that company. So same way, people are ready to pay, the investors are ready to pay a higher price for the shares of the company which has got a higher reputation or higher confidence. So P ratio, higher the P ratio, it indicates higher investors' confidence. Okay. Now let me look at the queries, if there are any. Yield ratios. Yield ratios are basically based on market price. What is the return you're getting? Anmol, based on yield ratio is basically return on the basis of market price of the share. You might have bought the share at some price and you might have earned some earnings on that. So what is that percentage based on the market price? Okay. And next is why we can't take gross profit in operating profit ratio. Operating profit ratio, gross profit. No, no, no. Gross profit is not something which you're talking of. We're not saying gross. Operating means what is the cost, what is the profit that you have from the business operations, not from only the production or trading. So operations include your administration and selling expenses. Anmol, all the return ratios will be in percentage. Return is always expressed in terms of percentage. Okay, so here we complete with the ratios for the day. We have some more few concepts that we are yet to discuss. We'll discuss them in Saturday's class and also take up certain questions. I'll make sure I upload this on the portal today itself. So I'll do it immediately. Then there's a doubt by Abhishek. I have a doubt on page number 1.28, theoretical question number 2. In answers, it is given refer para 2, but I didn't get what to write for these questions and how much. That depends, Abhishek. That depends on the marks allotted for the question. If the marks are substantially larger, you need to explain all the concept. If it is not, then only the relevant point needs to be written in that. Okay. In practical life, where these ratios are applied and what use of this? Well, Hardik, the answer lies in the very first question that I asked you today. That was, what factors will you consider for investment in a company? You're not going to look at the face of the director or the brand ambassador before you make the investment, right? So if you have a company whose brand ambassador is, let's say, your favorite actress, are you going to invest it? No, right, Hardik? So it's not on the basis of brand ambassador or something the investment needs to be done. To do an investment, you need to undertake some analysis of the company, and for that purpose, we need to calculate the ratios. I hope I have answered your query. Shini is asking, before investing, what should we consider as an ideal PE ratio? Ideal PE ratio, Shini, again depends on company to company. Uh, Certain companies enjoy high PE ratio, certain companies may not enjoy that, and it also differs from industry to industry. Okay, last lecture still not uploaded. I'll do that, Avinash. Just give me a day's time. Okay, he probably will. Someone is asking that he will invest on the basis of face of a company director or the brand ambassador of that company. Fine. Okay, there's no other thing. Okay, we have certain ratios yet to be covered. One is your price to book ratio, market price to the book value ratio. Then second thing that we have is Q ratio and DuPont analysis. So these three concepts are still pending. PB ratio and all those things. We'll be doing them on Saturday's session. Along with that, we'll be doing certain questions also based on that. I will upload. Please, sir, note. I will definitely upload it. Just give me a day's time, guys. Okay, so I think that's all for the day. There are no other queries pending as of now. Fine. So let's stop here for the day, guys. See you on Saturday. Till then, enjoy, keep learning. Thank you so much. Good night.